How's it going, guys? It's John Boyd from Modern Wealth. That's modern with no vowels. Wealth certified financial planner, founder, and lead wealth advisor here. We're talking all about covered calls, buy right strategies, pros and cons, and how they fit into a portfolio. Right now, there's a lot of hype about covered calls and buy right strategies. A lot of that has to do with the volatility that we're seeing in markets. It's generating extra juice to those strategies, and therefore they're paying out more cash flow. But there's always a catch. There's always a catch. And if you don't truly understand these strategies, you could get burned. You get burned big time. So got my glasses on because we're going to be diving into some examples. And so hopefully you learn a thing or two. So before we dive into the example, let's talk about what a covered call even is. So a covered call or buy right strategy, it's an option-based strategy. So it utilizes options. A lot of folks, when they think about options, tend to think, gambling or speculation. And you certainly can use options in that manner. But the reality is that options are more so used almost like insurance. It's probably the best way to think about an options strategy. And it's probably the best way to think about it from the context of thinking about the contracts themselves. There's a buyer and a seller. Just like with insurance, there's a insurance underwriter, somebody who sells the insurance, and then there's someone who buys it, who really wants it, right? So in our case today, a covered call is when somebody sells a call on a position that they own. So you own a stock and you decide to sell a call on this stock in order to generate some income, right? You plan on owning this thing. You think, heck, why don't I juice the yield on this stock a little bit by selling a call on the position? That's a covered call strategy or buy right strategy. Now, the catch when you sell a call on a position is that you now are at risk of capping your upside. And that's what people tend to have issues with, or they tend to lose sight of. So earlier on in my career, I was a broker at a large firm and had to deal with a lot of clients who would trade options and think that they could day trade and do stuff like that. And one of the most common complaints that people had when they would sell a call on something was that the stock would be taken away from them and be like, hey, what the heck? I didn't sell this stock. Well, once your covered call is in the money, you're at risk of that stock being taken away from you. Even if that stock goes to the moon, your upside is capped and that stock could be taken away from you at any time from that point on while that contract is in force. So we're going to talk about some examples and dive into if it even makes sense to utilize this strategy. So let's give a more formal example rather than me talking about it at a high level, and we'll go from there. All right, guys. So here's the realistic example that we're going to use, right? So rather than just talk about it hypothetically, let's try to use an actual example. Now, full disclosure, this is not a recommendation for SPY. I'm not affiliated with Invesco, Spider, any of these companies that we talk about today. This is just purely used for the sake of teaching an example. Okay, so we're utilizing SPY, which is an S&P 500 ETF. Okay, we're going to say that you own 100 shares of SPY. So you own 100 shares of SPY that tracks the S&P 500. You decide at some point, you know what? I want to generate some income from owning this position. So you go ahead and sell a call on it. As of today, and today for this example is March 8th, 2023. March 8th, 2023. The price of SPY, we'll say, is $398 a share. $398 a share. You decide to sell a call with a strike price of $416, and it expires on June 16th, 2023. That's about 101 days out. The bid on that contract, so that's the price that you sell it at, is $7.69. You multiply that by 100. One call gets you $769 in premium or income in your pocket. So $769 divided by the value of your 100 shares, which is $39,800. That's a quick return of 1.93%. If we annualize that, 365 days in the year divided by 101 days until expiration, 3.61. 3.61 times 1.93. That's an annualized yield of 6.97%. Right? So imagine, again, you own SPY and you see this data and you think, wait a minute, I just got to sell this call. I don't need to do anything. And I get a quick yield of 6.97% on an annualized basis. Gee whiz, I'm going to do that with my entire portfolio. That's easy money in my pocket. I barely had to do anything, right? Well, here's the catch. Here's the catch. So what exactly did you do from a contractual basis, right? Think of this like an actual contract. From a contractual basis, on the other side of this contract, you don't know who this other person is on this other side of this contract, but what you just agreed to by selling this contract to whoever this person is for $769, you agreed that within the next 101 days until expiration, if your shares of SPY go above $416 a share, you've agreed that other person has the right to take your shares away from you. They can take your shares away from you at any time. So let's say SPY, as soon as you do this, rallies. It just goes on a rip and is up 15% and is now at, call it $457 a share. So you own it. It went up to $457 a share, but remember, you sold this call with a strike price of $416. The person on the other side of this contract could decide to say, hey, you know what? It's at $457. I have this call to buy it at $416. I'm going to go ahead and make this person sell me their 100 shares for $416. And they can do that. So now you are forced to sell your SPY shares at $416 a share, even though it's at $457 a share. That's an extra 10%, effectively in returns that you missed out on because you rather have taken a quick 1.93% in income, right? So that's what you sacrificed in order to get that income. So there's a lot going on here, but what's the summary of all this? Covered calls are not a free ride. They're not some mechanism that is just easy money, right? This is a relatively vanilla example, but it's completely conceivable that you could juice the yield and get 12, 13% in some cases, right? 12, 13, you could even do it higher if you really, really wanted to, right? And so people see those large numbers and they think, wow, 10, 11% cash flow and I don't have to lift a finger? Sign me up. And they tend to lose sight of this. They tend to lose sight of the fact that your upside is capped. And what do we know about something like the S&P 500 or stocks in general? Stocks generally go up. Over the long run, they go up. And since they historically go up, you are consistently capping your upside potential because you're choosing to deploy this strategy. Now, let me pause here. It isn't all doom and gloom. There are benefits to this type of strategy. But let me talk about my issues with the strategy. Number one, probably my biggest issue with the strategy is that folks will put this as a primary equity strategy in their portfolio, right? We'll take a young person, because I've seen this happen with young people. They'll have, 100% stock exposure, and they'll have 40% of their portfolio allocated to a covered call strategy. Why the heck would you do that? Why would you cap your upside potential for some income? Do you need the income? Right? You're 20 years away from retirement. You don't need the income. Right? Why cap your upside? Do you have a strong appetite for risk? Why cap your upside? Right? But people do that. People do that because they see the yield and they think it's easy money. Easy money. And again, that right there is probably my biggest issue with a covered call strategy, is that your upside is capped. The second is that folks tend to lose sight of the fact, if they're doing this with individual securities, that again, your option could be called away at any time. Most people think that it happens just on expiration. As soon as your call is in the money, person on the other side of that can take your stock away, right? They don't need to wait till expiration. They could do it at any time they want. And so when folks forget that, their stock gets taken away and they think, shoot, I was just going to get rid of the position and just keep my stock, right? Not how it works. Not how it works. You could easily get burned that way. The third issue that I have with the covered call strategy is that if you notice the example, right, that was one contract on something like the S&P 500, that equates to around $39,000 in a single position, right? For $769. That's a lot of money. It's highly capital intensive, really capital intensive strategy. And most investors, if they're going to try to replicate that themselves, are going to struggle to find capital to make that happen, because it's just really, really expensive. Really, really expensive. So we've talked a lot about the bad, right? A lot of the negatives with the covered call approach. Well, let's talk about some of the positives. Okay. So first example that we'll utilize as a positive, we'll go back to the whiteboard, is that the covered call strategy can be used to finance the purchase of downside protection. So let's say in the same example, right? You own SPY at $398 a share, but you want to protect yourself in the event that SPY falls below $378 a share. You want to protect yourself, right? Selling that call is only going to give you a small degree of downside protection. So what you do with that $769 that you brought in our previous example, at $769, is you go ahead and buy a put. You buy a put to give you insurance so that you're guaranteed to never sell your position below $378 a share, right? So by doing that, you sacrifice some upside potential to finance some downside protection so that you're guaranteed to never lose more than $378 a share. And if you do this right, how much you pay for the put versus how much you received in premium from the call could net out to effectively zero, right? So you've completely financed it with no money out of pocket. That strategy that I just described is more formally known as a collar, but it can provide some downside protection. So that's one of the big pros with a covered call strategy, is that you can use that money, just turn around it and finance some additional downside protection. The second big pro is that covered calls can be utilized to provide some income, right? They can be used to finance and help provide cash flow, especially for someone who is in retirement. Now, when our firm is designing a retiree's portfolio, we may, and there's at times where it might make sense to incorporate elements of a covered call strategy. Again, it's not suitable for everyone, but there are times where it makes sense to incorporate elements of that to help subsidize and cover some of their costs in retirement, because of that heavy cash flow that the strategy can generate. The third big pro that can be found with covered calls is that nowadays you can get exposure to the strategy within a ETF or even a mutual fund, right? And if you get exposure through a fund to a covered call strategy, it's a lot less capital intensive. You can spend maybe $5,000 and get exposure to a covered call strategy. You could spend $5,000 and get exposure to that type of collared strategy that I had brought up. And when you look at the volatilities of strategies like that, especially with depending on how you design them, right? Because we can get more complex. You can design them in a way where they're more focused on, let's say, more defensive, low volatility stocks, plus you have covered calls incorporated in it. And when you combine the dividend cash flow plus the covered calls, the strategy is relatively low volatility and could, in theory, be used as maybe a bond replacement, right? That's all in theory, but it's logical. It's perfectly logical. It could make sense to you. It could very well make sense to incorporate elements of a covered call or options-based strategy to help diversify away from traditional bonds in the portfolio to increase your cash flow and help reduce sequence of return risk and lower your overall portfolio volatility with an options-based strategy. And again, at our firm, at Modern Wealth, we are big on alternatives. We love to incorporate assets that are outside of just traditional stocks and bonds. And this is a way, depending on the client's need, where it could make sense. So let's tie this all together and bring it on home. Covered calls. Are they a bad strategy? No, they're not, right? When used correctly and responsibly, and when you truly understand what you're getting yourself into, covered calls can be a great way to not only diversify your portfolio, but help increase the cash flow that is being kicked off of your portfolio, help diversify away from traditional bonds, help diversify the types of stocks you have, right? They can be brilliant when used responsibly and correctly. But if you don't know what you're getting yourself into, if you're someone who needs more growth and you're putting covered call strategies in a portfolio, right? That's where you need to kind of take a step back and think, hey, what's the trade-off here, right? just because maybe a fund is telling you that it spits off 14, 15% in yield and it's a covered call strategy, think for a second, think, hey, what's the trade-off here? What's the trade-off? Are you giving up significant upside for that covered call premium? You very well could be. You very well could be. Again, our firm utilizes options. There are tons of different option strategies out there. Options, when used responsibly, are fantastic tools. But again, it's very easy to get burned and really hinder portfolio returns if you do not know what you're getting yourself into. So if you're looking to perhaps diversify your portfolio and incorporate kind of alternatives and options-based strategies into your overall financial plan, by all means, reach out to us, www.modernwealth.com. That's modern with no vowels, mdrnwealth.com. Reach out. We do free financial plans for all prospective clients. I hope you found this helpful, and good luck.